Do you want to invest in Saudi Arabia's real estate sector but do not have sufficient money? Today, I want to explore a very interesting asset class that has been listed on the Tadawul Stock Exchange, which hasn't been explored by many others. So, if you're interested in the real estate sector of Saudi Arabia and would like to understand opportunities of investing and betting on this sector, please follow this video. The three main topics I want to cover today is a quick introduction to REIT, what are the investment opportunities via REITs, and what are some of the key factors of evaluating a REIT. Most of us might be following the Saudi Pro League with many of the famous global stars entering the Saudi Pro League, like with the likes of Ronaldo's, Benzema's, Mane's, Neymar's. It's not just the players who are entering Saudi Arabia, but it's also, the different MNCs, different mega projects, expats, tourists who are seeing a huge spike in entering towards the Saudi Arabia markets. A recent report by one of the leading real estate agencies in Saudi Arabia stated some key facts. The residential market price has increased by 17% and 12% in Riyadh and Jeddah, respectively, which are the top two cities in Saudi Arabia. Some of the world's mega real estate projects are from Saudi Arabia, like the Neom city, the Salman Park, which will be even bigger than the New York's Central Park, as well as the world's tallest tower, which will very soon be replacing Burj Khalifa. And thirdly, we also have a lot of the MNCs headquarters shifting from multiple cities outside Saudi Arabia to Riyadh and other cities in Saudi Arabia. So what are the different ways in which investors can enter the real estate market in Saudi Arabia? There are three main approaches, like in any other real estate market. Number one is to purchase directly the land or apartments or plots, right? But that's only for the ultra rich people. I cannot afford to spend 1 million riyal to buy a 1 BHK apartment in the central downtown of Riyadh at the moment. Option number two, you invest in stocks of companies who are participating directly or indirectly in the real estate industry, like those providing the raw materials, cements, wiring, steel, etc. And option number three is what I will be deep diving into, which is the REITs, that stands for Real Estate Investment Trust. So what is a REIT? REIT is a trust which owns or operates or finances income generating real estate. So you can assume it to be those institutes that have purchased large areas of land and have rented it to either hospitals or malls or IT parks or MNC companies. So essentially, these trusts are purchasing plots, renting it to specific customers, and then getting rental yield from these customers. The main objective of a REIT is to invest in income generating real estate assets to earn regular rental income and distribute at least 90% of that income in cash to investors quarterly or monthly. The cash distributed will exclude any capital gains arising from the sales of the assets. So if I had to simplify REITs, in a minute to you, it would be an institute which would take money from individuals like us or foreign investors or institutions, banks, companies, etc. They will purchase land, which will be then rented out to malls, hotels, offices, hospitals, etc. You then get a rental income from them. Once you have collected it, exclude a bit of the management fees and expenses, and then distribute the remaining back to the investors, individuals, companies, institutes, etc. That's the short summary of a REIT. Before I proceed further, I really wanted to, request all the YouTube viewers of my channel to like, subscribe to my channel. These are some of the topics which hasn't ever been covered on YouTube or anywhere else and explained in layman language to common investors like us. So it would really mean a lot to me if you could like and show your appreciation for the content that I'm producing here. So yeah, as I was saying, on Tadawul, we have 19 individual REITs that have been listed, of which 18 of them are on the main markets and one of them, which is the Al-Wahar REIT, that's listed on the parallel secondary market. So what we see here is like the Jadwa REIT, Saudi, Snbcapital REIT, Riyadh REIT are some of the biggest ones, which actually falls under the small cap or the micro cap index, and going down to the Seco Saudi and the Al Jazeera REITs, which is more focused on compounds. Now, another important thing which I wanted to also showcase here is REITs is not something new. It's a very old asset class that has been existing since the late 1900s on the New York Stock Exchange, have shown a lot of good appreciation and dividend yields for the investors. And there are different types of REITs, right, based on the type of properties that has been rented to. For example, there could be like a hospitality REIT, which is majorly driven by the hotels. There could be hospital REITs, which is majorly driven for hospitals. There could be warehouse REITs, which is majorly driven for warehouses, logistics centers, 3PLs, etc. So how do a normal investor make money from REITs? There are two ways. Okay, there are two essential ways in which investors can make money via REITs. One is from the capital appreciation from the market price listed on Tadawul, And secondly, based on the dividends that has been given back to the investors. Now, you need to understand that these two can at times work in opposite directions, right? Because the trust has to return back almost 90% of the income, also means that they will not have sufficient fund to purchase new lands and to rent it out to new customers, because which also means that the capital appreciation can take a hit because of this high payout of dividends that's happening. So at times you will see that capital appreciation might not be that much, and in fact you will also see that they are more negative in most of the times, because they have to pay back a lot as dividends. What are the 7 factors that can help you to evaluate or at least get a basic understanding of how the REIT is performing? The most important factor that has to be evaluated to understand a REIT is the diversification in terms of the customers, in terms of the location, in terms of the industry that the trust has given its land or rented out to. So, for example, the 3 scenarios which I wanted to show you. Number 1, let's say scenario A is where this REIT has purchased lands and rented out just to one single customer, which is Lulu in this example. So Lulu has set up, its warehouses, its hypermarkets in Jeddah, in Dammam, in Riyadh, right? And that's the only one customer that this REIT is providing its land to, which puts the REIT into a big risk. Because if, for example, Yusuf Ali, who is the CEO of Lulu, comes, some one day, wakes up in the morning and dreams that, okay, let me get rid of this land and let me switch to some other property owner, that means our REIT will be completely destroyed in terms of the property, because it's so difficult to find like new customers and diversify. Scenario A, where there was lack of diversification in terms of customer. Let's take scenario number 2, which is diversification in terms of location. So let's say this is a REIT which has been investing in plot purely in Jeddah, right? You've got some of the hottest locations of Jeddah where you have rented out to different customers, from different industries as well. But let's say over a period of time, Jeddah, or let's say you were betting on Al Khobar or Dammam, right? But over the period of time, the population and a lot of the economic development is moving towards Neom, or it's moving towards Riyadh, which means that the property value of Jeddah itself is slightly going down, which also puts the REIT under risk. That's the risk due to lack of diversification in terms of location. And scenario 3 is where there was a lack of diversification in terms of industry, because you have been giving your land to customers who are part of one specific industry. For example, let's say you were renting it out to all the hotel chains like the Hiltons and the Marriotts, which also puts you under risk, because maybe due to COVID, people are not traveling, the occupancy rate suddenly goes down, and therefore you're again put under risk. So an ideal REIT portfolio should have diversification in terms of customer, should have diversification in terms of location as well as industry, so that you are trying to minimize the risk that comes due to multiple factors. Maybe a customer completely shuts down, or a location is going down or depreciating in terms of value, or an industry is completely, taking a hit due to some uncontrollable factors. So good portfolio should have a variety of properties which comes across these 3 key factors. The next important factor would be to have diversification in terms of not relying into just a few properties. So if your portfolio is just consisting of 2 or 3 properties, and therefore almost 50% of your rental yield is just coming from one property, that also puts you under risk, because then you're highly relying on one specific property. So ideal portfolio should at least have like 15 to 20 properties minimum, so that the per portfolio weight is around 5% or even less than that. That would be like a good mix. The third factor would be the occupancy rate. You might have a great portfolio, but for some reason, if no one is using it or no one is occupying that property, that also puts you under risk, because you're not then getting yield or rental income from that property. So always make sure that the portfolio that you want to invest in has like a high occupancy rate. A good occupancy rate would be somewhere above 85% is superb, right? 80% or beyond that is like amazing. That's a good indicator that people are interested in renting out those locations, and therefore your REIT will have a higher rental income. The fourth one is the net asset value per piece of land, which means it's kind of like an indicator of the value of the property that you have. For example, you might be having 100 million square feet of land, but the overall value is 100 million, which makes it like 1 riyal per square feet. That doesn't make sense, right? It means like you might have been having a lot of land, but it's in some of those locations which no one cares about, or no one wants to reside in, or no one wants to invest in, right? So this is a good indicator of the market value, or how hot the properties that you own is in terms of the mindset of the investors. The fifth factor is the debt to equity ratio. By default, real estate market is highly relying on debt. You cannot avoid it, right? Because you have to invest a lot upfront to set it up, to manage the logistics, development, etc., and then only you start getting income, right? So it's heavily relying on debt. However, but if you're over leveraged, if the trust is over leveraging on debt based on the market value as compared to the market value of the equity, that's also like a very bad indicator. So for example, if your debt to equity ratio is somewhere close to above 75% or more than 100%, that's like a high risk. Even above 50% is actually something preferably to be avoided. The sixth factor is the weighted average lease expiry. It's kind of like an opposite of what occupancy rate is. This is an indicator of what's the time frame left for the property to be vacant. So for example, if I'm the owner of Lulu warehouse and I'm coming to your REIT trust, right, and I want to rent out this land for the next 10 years. So my weighted average lease expiry is 10 years. After 9 years, I just have 1 year for my lease to expire. If I'm not interested or if I want to vacate that land, that's a bad indicator, because as this number goes down, means that very soon the renters are going to vacate your property, which also means that you will start seeing a decline in your rental income. So lower this number means it's bad. Higher the number means there's still time for that income to start going down, so that the trust can also find time and opportunity to start exploring some new customers, to approach new customers. And the last and seventh factor is the dividend yield itself, right? Of course, higher the better, right? It's the payment that's made every month or every quarter or every half yearly, depending on which REIT it is. And typically, what I've seen historically for some of the biggest ones is close to 3 to 3.5%, which is very good, right? As compared to the fixed deposits rate interest that you're getting in some of the leading banks over here. So these are I won't say this is an exhaustive list, but these are the top 7 based on my personal experience and based on some of the literatures that I've read that really plays a factor in evaluating the performance of a REIT. Now, coming to the most interesting part, let me show you one of the bad examples I could find on Tadawul at the time of this recording. It's not like an investment advice that I'm giving, like not to buy it or to buy it at the same time, but it's all just to show you a template of how I would evaluate this. And I'm explicitly only showing one of the examples here, but I did have this evaluation done for almost all the 18, 19. If you are interested to learn or to have a deep dive into some of the REITs, let me know in the comment section, and I'm happy to cover it, in the coming weeks and months. So the REIT example I wanted to cover is the Alahli REIT Fund 1, which is by the snbcapital. So if you go through the documentation of this, essentially you have 4 key properties that it's owning: the Al Andalus Mall, the Mall Plus Hotel, Salama Tower, and the Riyadh Office Plaza. It's 63% relied on the mall, and then almost 11 to 13% the remaining 3. So number one red flag for me is it's really having 4 properties in its portfolio. Of course, I've been to the Al Andalus Mall in Jeddah. It's quite big, amazing property, and you will see a lot of rental income from there. But however, you're putting a lot of importance to that one mall, which also puts you under risk for, let's say, God forbid, but something happens to this property, or for some reason the customer would like to vacate this and switch to some other location, that will put you under risk, right? The occupancy ratio has been great, but you're over-indexed in terms of the customer, which is Andalus. Almost 75% is relying on this one customer, and it's located in Jeddah, which also means in terms of location, you're over-indexing on one specific location, and it's part of the retail or the mall, which is more part of hospitality and retail sector, which also puts you under risk, right? So for me, it's not a great portfolio to put your money into at this point in time. But however, in terms of occupancy rate, it's showing a steady occupancy rate of 94%, except for the mall hotel, which is close to 56%. But for the hotel industry, hospital industry, that's also like a pretty decent number. Uh, some of the average hotel um, occupancy rates have been close to 30%, 40%. So this is good in terms of occupancy rate. In terms of the historical dividend payouts over the last 3 years, it has been very close to 3%, which is not bad. In terms of debt to equity ratio also, it's close to 33%, which again, as I was mentioning, anything below 50% is okay. It's good. I'm very uncomfortable in investing in this REIT because it's over indexing on one customer in one location in one industry, which does not make it a great portfolio to invest your money in. And there are similar few examples as well, which I am not covering in this video to keep this short. But if you're interested, happy to cover them in subsequent videos as well. All right, so this is a quick introduction to REIT, which I wanted to cover. Just a recap. I explained what is a REIT, what are the investment opportunities in this asset class, what are some of the key factors that has to be taken into consideration when you're evaluating the performance of a REIT. Do keep in mind that a lot of data for some of these metrics that I was covering is not yet readily or publicly available for the Tadawul investors. Like I can find it for the New York Stock Exchange or a national stock exchange in India. However, you can still find some of the information in their annual reports or in their quarterly reports, which would be like a good starting point to start your research into. I hope you like this video. Again, a simple one click on the like button and one click on the subscribe button would mean a lot to me.